If your account keeps bleeding out slowly, it's probably not your discipline. It's not your broker. And no, the market isn't rigged against you, it's your setup. Most retail traders are running one of the 4 setups I'm about to show you. And the way most people trade them, 3 out of 4 are quietly costing you money. So in this video, I've ranked the 4 most common trading setups from worst to best, based on how they actually perform for real traders, not how they look in a course. By the end, you'll know exactly which one to drop today, and the one that consistently profitable traders quietly rely on. Here's how this works. I ranked these 4 setups on 3 things: the odds of the trade actually working, the risk to reward it hands you, and how hard it is to execute without blowing yourself up. First, we count down all 4 setups, from the worst one you can trade up to the best. Second, for each one, I'll give you the same 3 things: the weakness that's costing people money, the one time it actually works, and how to trade it properly. And third, I'll break down the number 1 setup in full, the exact entry that professionals build their edge around. These setups work across every market: stocks, forex, and crypto. This video is for every trader. Fair warning, number 4 is going to sting because a lot of you are using it right now. Let's start at the bottom. Number 4, the worst setup on this list, and the one beginners fall in love with first: reversal trading, trying to catch the exact top or the exact bottom. Here's why it's so tempting. Calling a top feels smart. It feels like you saw something the crowd didn't. And when it works even once, the story you tell yourself about it is intoxicating. But here's the problem. When you trade a reversal, you're betting against momentum. You're standing in front of a train and hoping it stops. And the market can keep running far longer than your stop loss or your account can survive. There are 100 ways for price to keep going, and only one way for you to be right. Those are bad odds. That's why this sits at the bottom. So, does that mean reversals are useless? No, real reversals happen, and when you catch a genuine turning point, the risk to reward can be enormous. That's the one situation where this setup earns its place. The fix is simple: stop anticipating and start reacting. 2 things have to be true before you touch a reversal. 1, you're at a major level, a higher time frame support or resistance that actually matters, not a random line you drew. 2, you wait for confirmation. Price has to show you it's turning, a clean rejection or a break of the short-term structure in the other direction. Anticipate and you're gambling. React and you're trading. That's the difference between a reversal that blows up your account and one that actually pays. Number 3, the moving average crossover. You've seen it in 1,000 videos. When the fast line crosses above the slow line, you buy. When it crosses back below, you sell. Clean, mechanical, no emotion. And in a strong, clean trend, it genuinely works. That's its one real strength. It keeps you on the right side of a big move, and it takes the emotion out of your hands. But here's the catch, and it's a big one. Moving averages are built entirely from past price. So the signal always arrives after the move has already started. You're buying late and selling late. And then there's the bigger problem. In a range, which is where markets spend most of their time, it gets chopped to pieces. Cross up, lose, cross down, lose. Death by 1,000 paper cuts. Think of a moving average like a rearview mirror, useful for understanding where you've been, useless for steering. So how do you actually use it? Stop treating the crossover as your entry trigger. Treat it as your filter. Use it to tell you the direction. If price is above a rising moving average, you're only hunting buys. Then get your actual entry from something with better timing, like structure or a pullback, which, spoiler, is exactly where this list is heading. Number 2, breakout trading. Price has been coiling under a level, pressure building, and then it breaks out and runs. Catch that, and you're in at the very start of a big expansion move. When it works, it's beautiful. Momentum is on your side from the first second, and the moves can be fast and clean. That's why it ranks this high. So why isn't it number 1? One word: fakeouts. Price pokes just above the level, sucks in all the breakout buyers, then reverses straight back down and hunts their stops. The market knows exactly where those buyers are stacked. So if you chase the first candle, you're constantly buying the top of the move and getting shaken out. Here's how you fix it. 2 rules. 1, wait for a candle to actually close beyond the level, not just wick through it. 2, and this is the high probability version, wait for the retest. Price breaks out, comes back to kiss the level from the other side, and holds. Now, the level that was resistance is acting as support. That's your entry, with a much tighter stop and far better odds. And one final filter: only take breakouts in the direction of the bigger trend. A breakout with the higher time frame trend behind it is a setup. A breakout against it is usually a trap. So breakouts are strong, but there's one setup that beats all 3 of these. A setup that doesn't need you to predict anything, doesn't need you to chase, and hands you the tightest stops and the best risk reward on the entire list. It's also, frankly, a little boring, and that's exactly why it wins. Here's number 1, the best setup on this list. And I'll be honest with you up front, it's a little boring. That's exactly why most people ignore it, and exactly why it works. The trend pullback, also called buying the dip, but done properly. Here's the whole idea. Instead of chasing price at the top of a move, you wait for it to pull back to a level, and you buy the dip inside an existing trend. You're doing three powerful things at once. One, you're trading with momentum, not against it. The trend is already doing the heavy lifting for you. Two, you're entering at a discount. Price came back to you, so your stop can sit tight just under the level, which means your risk to reward is excellent. And three, it's repeatable. This same setup shows up over and over on forex, on stocks, on crypto, on every time frame. You learn it once and you can hunt it forever. Sounds almost too simple, right? That's the trap. Simple isn't the same as easy. Miss one step and it falls apart. So here's the exact sequence. Step 1, confirm the trend. Higher highs and higher lows for a buy, lower highs and lower lows for a sell. If there's no clear trend, there's no trade. This setup only works with the market, never against it. Step 2, wait for the pullback into a level that matters. Prior support, a key moving average, or a trend line. A level price has respected before, not a random line. Don't enter during the pullback. We're waiting for confirmation. Step 3, wait for confirmation at the level. A rejection candle or a shift back in the direction of the trend. This is the part beginners skip, and it's what keeps you out of the bad ones. You enter on the close of that confirmation candle, put your stop just beyond the level, and target the next swing, aiming for 2 to 1 or better. The confirmation is the entry, not the pullback. Let me show you how it looks in practice. First, a cleanup trend, higher highs and higher lows, so we're only looking for buys. Then, price pulls back into a prior support level, an old resistance that's now acting as support, and it stalls right there. A rejection candle forms at the level. That's our confirmation. We enter on the close of that candle, put the stop just below the level, and target the previous high. A 2 to 1 reward or better. From there, price pushes up and hits the target. Look at the risk to reward. You risk a little to make a lot. No predicting, no hoping. You waited, the trend did the work, and the level gave you a cheap entry. That's the whole edge in one picture. That's it. No calling tops, no chasing, no fighting the market. You let the trend set the direction. You let the pullback give you a cheap entry, and you let confirmation keep you out of the bad ones. It's not exciting. It just works. And that's the whole point. Now, knowing the best setup and actually trading it with real risk management are two different things. If you want the exact step-by-step framework we use to trade that #1 setup, how to mark the levels, read the confirmation, and manage the risk, we put together a completely free training that walks through the whole thing. It's linked in the description. No cost, no catch. If this made the market feel a little clearer, hit that like button and subscribe. That's exactly what this channel is here for. And I'm curious, which of the 4 are you trading right now? Drop the number 1 to 4 in the comments. Be honest.